Hello everybody, this is Chuck Carnevale, and I'm the Chuck in the Markets Up Chuck. And today's post was titled, Not All Price Drops Are Equal, because I think it's really important that investors always have a clear perspective and are thinking their way through the investment process. So I'm going to look at various kinds of price drops and how, not only do they mean different things to you as an investor, but they also require different strategies in order either to correct them or to simply deal with them. So first of all, I'm going to look at what I would call a bad price drop. I'm going to look at a company, Lazy Boy. Most of you know the company, the furniture manufacturer. I want you to notice they had earnings growth here as connotated by this blue line in the first 4 or 5 years. Then they got a little cyclical. Then, really since 2003, you can see their earnings have fallen dramatically, and their stock price has fallen from a high of 30 all the way down to $3.64. This is basically a bad price drop. Every one of the price drops in Lazy Boy here was bad because it was continuing deterioration of fundamentals. This type of company, in my view, should be sold. My second example is MBI Corporation, a municipal bond insurer, the largest. You can see that it had good earnings growth, and stock prices followed that pretty well. Then, of course, they ran into that financial services debacle with the CMOs and CDOs and all the other collateralized debt obligations. Their earnings fell from $6.12 a share down to a loss of $10 a share, and this is a very bad price drop, and this is the type of company that should be sold because this is, again, deteriorating fundamentals, and there's no reason to be looking at buying more or holding on to this stock. My next example is the great tech company Cisco, really the leader in internet servers and so on, and this company, routers and switches. This company, as you can see, was a company whose stock price got dramatically above its earnings justified level. The blue and green line down here represent what the company was worth. It was worth about $10 a share in July of 2000. It was trading up here at 77. The price has collapsed, and obviously anyone that bought the stock during this irrational exuberant period can look out 6, 7, 8, 9 years later, and their price is still nowhere near what it was when it was trading overpriced like that. When the stock is overpriced like that, the period is too long, it needs to be sold. My next example is IDT Educational Services. You can see this company had great earnings results. The stock price has tracked earnings, very, very clearly. There were a couple times where it got above earnings. But here's a case where the stock price fell from being in value. If you look at it here on November, it was traded at 113. It was in value there, fell all the way to 46 by March of 2008, recovered back to 113 by February. So here's a case where the stock fell from being undervalued. It recovered very quickly. It's had another sell-off again back into 92, but I would argue this is a company that should be bought because it's falling from being fairly to undervalued, and therefore recovery would be expected to be quick. My next example is Fiserv, another company with very consistent earnings growth. You can see a period of overvaluation. Anyone who bought the stock back in this irrational exuberant period where the price was so far above its earnings line would have had to wait years for it to come back, but it eventually did come back. But in this last salvo, in August of 2008, it fell from 51.86. It got all the way down to 32 5/8, and has since recovered back up to 46. So, this is a case of a company that should have been bought down here because it's fallen from being fairly valued, and recovery has already been very quick, and it would be expected to continue to recover very quickly in the future. Then my final example is a company also featured in yesterday's post, and this is HDFC. This is an Indian bank. And the reason I wanted to show this was you have a period here where the valuation was excessively overpriced and earnings continued to do well. If you had bought the stock up in these areas here, then and it fell, recovery is still going to be many years out before you would expect this stock to be, return back to these high levels. On the other hand, as you can see, as you get closer here to valuation, when the stock was trading in value at around $65 a share in October of 2008, and it fell down here into the 40s, the low was 45. It's now recovered back up to 101, and it did that in a very short order. The bottom line is when the stock price falls from being fairly valued or even from being undervalued, then recovery can be very, very quick, and you have to deal with stock drops differently because not all stock drops are the same. And the basic message that I'm always trying to deliver on these posts are valuation and earnings growth are critically important. You can see here the stock tracked earnings very clearly. When it got overvalued, the price corrected back to valuation. When it got undervalued, it came back. So, paying attention to those things are important for investors, especially investors with the what I consider to be the more intelligent long-term view. This is Chuck Carnevale saying thanks for listening. I'll talk to you again tomorrow.